All right, so let's keep going in our discussion of stockholders and stocks and dividends and so forth. And need to talk about cash dividends. Now, believe it or not, cash dividends are not the only type of cash dividends. We can issue dividends by way of assets, but by large, cash dividends are by far the most common type of dividend to share in company earnings. Usually when we're paying out assets, that's because the company's gone out of business. So when it comes to cash dividends, there are some criteria that we have to meet. We need to have sufficient retained earnings, we need to have sufficient cash, and then we need to have a formal action by the board of directors. Now, we talked about this in the previous video. We had a slide, hey, how does all this happen? Well, it does take a formal action by the board of directors. So, we've got asterisks by these two items here. But the fact of the matter is, before we even get to these two items, we have to have a formal action by the board of directors. All right. We certainly have to have sufficient cash to pay the dividends, and we don't ever want to pay dividends out to the point that retained earnings it becomes a debit balance. Now, the good news is retained earnings generally are far, far higher than the cash on the balance sheet. So if we have sufficient cash, we're probably going to have sufficient retained earnings. But regardless, these are the three criteria that must be present under normal circumstances to be able to pay cash dividends. So we've got three dates that we want to consider when it comes to cash dividends. The first one is the date of declaration. And it says the board of directors formally authorizes the payment of the dividend. We talked about this already. At that point, the corporation incurs the liability to pay the dividend. So this is important. We have a liability that occurs, and so liabilities are going up. Well, what does that mean? What does that mean for stockholders' equity? Well, it means it's going to go down. It means it's going to go down. As soon as we do that, think about the accounting equation. The date of record is the date the corporation uses to determine which stockholders will receive the dividend. This is an interesting thing here, because you would think, well, it would just be whoever owns stock on the date of declaration, but that's not really the way it works. Let's say that our date of declaration for dividends is February the 1st. We might say something like the date of record is March the 15th, because we're trying to encourage new investment. So we might say, okay, any stockholder on record as of the date, March the 15th, is entitled to receive a dividend in proportion to how much and what type of stock they invest in with the company. Okay, so we don't have to make a journal entry for this. This just helps us determine who's going to get the dividend. And then finally, the date of payment. This is the date the corporation will pay the dividends to the stockholders who own the stock on the date of record. It's also the date that this liability is going to go away. So we've got some kind of a complicated mess here, but we have a scenario. Now remember, we had the slide in the previous video that showed us, and this is a completely different scenario, I think. It is. But we had the slide that showed us how we would set up the journal entry if we were financing through a stock issuance, and we had the $500,000 in preferred stock and the $1 million in common stock, and then we put that, of course we got $1.5 million in cash, and then the $500,000 and the $1 million go into the stockholders' equity section on the balance sheet, and we separate those. All right, so we talked about that. Now let's look at this. Looks like we have 5,000 shares of preferred stock outstanding, $100 par, and they're telling us that for each share, the dividend amount is $2.50. We've also got some common stock, which has a $10 par, and we've got 100,000 shares outstanding. Now, the par value here doesn't really matter because we have the dividend per share amount, and then we have the number of shares that are going to receive the dividends. So with regard to the preferred stock, all we have to do is we take 5,000 times $2.50. We come up with 12,500. And then for the common stock, we take 100,000 shares times 30 cents. That's actually going to give us 30,000. We add the two together, and we have a declaration of $42,500. So on October the 1st, the declaration date, this company, Rojek Corporation, records the following entry: cash dividends, $42,500, and then cash dividends payable, $42,500. All right, to declare cash dividends. So we have a liability account going up. All right, now this is a really interesting account here, this cash dividends account, because it's ultimately just going to vanish into thin air whenever we pay this. Okay, but more on that later. It says here, second bullet point, on November 10th, the date of record, no entry is necessary, as this date merely determines which stockholders will receive the dividends. Okay, so there you go. Then on December the 2nd, the date of payment, Rojek Corporation records the payment of the dividends as follows. Well, we had a liability that has been satisfied, so we're going to debit that liability for the $42,500 that we set up right up here. But notice what happens with our credit. We're paying cash dividends, so it makes absolute sense that cash would be credited for $42,500. We never have to go in and make a credit entry to this cash dividends account. As soon as we made this journal entry right here, retained earnings went down. Stockholders' equity went down because this is $42,500 that we're no longer going to retain. Okay? So when we make this journal entry here, we're going to see two things. We're going to see this liability go away, and then we're going to see the cash balance drop by $42,500. We don't ever have to do anything to this cash dividends account. So we talked about cash dividends. We also have what are called stock dividends, where a corporation might say, hey, you know what? We are going to, we might pay some cash dividends, but in addition to that, or separate from that, we're going to issue dividends in the form of additional stock. So it says a stock dividend is a distribution, not of cash, but of shares of stock to the stockholders. Okay? Good information here. Stock dividends are normally declared only on common stock and correspondingly issued to the common stockholder. So if you were wondering maybe before, why in the world would anybody buy common stock? Because, you know, we talked about the voting rights, but those voting rights are pretty hollow. Usually a small number of investors are going to control the vote, because you get proportional votes based on how many shares you own. But here is the saving grace for common stockholders, at least the smaller common stockholders. is that if a company has a history of issuing stock dividends, only the common stockholders are going to get them. Okay, so it says here a stock dividend, pay attention, affects stockholders' equity mix, but not the overall total. Okay, so that's a kind of a confusing statement. So what do we do here? It says specifically the amount of stock dividend is transferred from retained earnings. We take it out of retained earnings because we are paying a dividend, and then we move it to paid in capital. Now, let's make sure we understand what paid in capital is. Paid in capital is our common stock account. The official name for it is paid in capital common stock. All right. So what we're basically saying is we're going to take some earnings and we're going to distribute them. We're not going to retain them. So that's why retained earnings is going to be debited, but then we're going to simultaneously say that this is that amount becomes an investment by the stockholders. So the mix is affected. Overall stockholders' equity is not. So just kind of a numerical example real quickly. We declare a stock dividend that totals $5,000. Retained earnings is going to go down by $5,000. Paid in capital common stock is going to go up by $5,000. All right. So from the stockholder's perspective, we've got an example here. A stockholder owns 1,000, let's say they own 1,000 of a corporation's 10,000 shares. If the corporation declares a 6% stock dividend, the stockholder's proportionate interest will not change. So before they held, there were 10,000 shares total. They owned 1,000 of them, which 1,000 divided by 10,000 gives them proportionate ownership of 10%. But now, by issuing this stock dividend, there are a total of 10,600 shares issued. Okay, and then if we were to take 10% and add that, that'd be 60 shares. So now that person owns 1,060 shares. They own 1,060 shares out of 10,600 shares. They still own 10% of the company's stock. Okay. Finally, stock splits are a big thing. Stock splits, companies that have a history of splitting stocks, attract a lot of investors. It says a stock split is a process by which a corporation reduces the par or stated value of its common stock. And I want to emphasize it's usually the stated value of common stock. We're going to base this on what the we need to focus on the market price, not just par, and issues a proportionate number of additional shares. And we're going to look at an example, so don't worry. It says a stock split applies to all common shares, including unissued and issued shares. So if we had a stock issue, or I'm sorry, we had an authorized stock of say 100,000, and we had only issued 60,000 of those. Well, those 60,000, let's just say that we split it 2 for 1, is going to become 120,000, and those authorized shares that we had never actually issued, the difference, 40,000, now that becomes 80,000. It says a major objective of a stock split is to reduce the market price per share of stock. Now, why would you want to do that? Well, if you have a company that has a history of earnings, by lowering the stock price, you can, in theory, attract more investors, broadens the number and types of stockholders that we have. So if we have stock that's worth, let's just say $50 a share, and it grew once from, say, $25 to $50, we can split that. Now the shares are worth $25 again, if this was what we would call a 2 for 1 stock split. And those investors are excited because they can buy their $25 share stock, and and pretty much, I mean, not be guaranteed, but there's a history that shows this is going to appreciate in value and it's going to build up. And by the way, the more investors we get, that's kind of a self-fulfilling prophecy, that makes the price of the stock go up. So let's look at an example here. It says Rojek Corporation has 10,000 shares of $100 par common stock with a current market price of $150 per share. The board of directors declares the following stock split. Each common shareholder will receive five shares of stock for each share held. This is called a 5-for-1 stock split. As a result, we have 50,000 shares now. We have the 10,000, which was up here, multiplied by 5 will be outstanding. The par of each share of common stock will be reduced to $20. From 100 to 20, we take that 100 divided by 5. Okay, so the par is reduced. And really the market value is also going to be reduced. If we were to do the math on that, 150 divided by 5 would be 30. Okay, but officially it's the par value that is reduced. So here we have an example. The par value of common stock outstanding is $1 million before and after the stock split, computed as follows. Originally we had 10,000 shares times $100 par value per share is $1 million. After the split we had 50,000 shares, but only times a par value of $20, still $1 million. It says additionally, each Rojek Corporation shareholder owns the same total par amount before and after the stock split. Only the number of shares and par value per share have changed. Okay. Stock splits do not require journal entry because only the par value and number of shares outstanding have changed. We are going to, however, disclose the fact that we did this in the financial statements.